Hello learners, welcome to the session. Today's session topic is understanding financial statements. We will understand financial statements, importance of financial statements, elements of financial statements, balance sheet, income statement, cash flow statements, statement of changes in equity. Let's begin with the session. Now let us understand what a financial statement. Basically, these financial statements are a formal record of the financial activities and position of a business, organization, or any individual. It summarizes the financial transactions, performance, and financial health over a specific period. Financial statements are structured documents that summarize an organization's financial position and performance over a period, naming maybe a month, quarterly, or annually, which serve as a critical basis for informed decision making, investor trust, regulatory adherence, and sustainable long term planning. Financial statement analysis involves a comprehensive examination of a company's financial statements, including the income statement, balance sheet, and cash flow statement. Analysts assess revenue, earnings, assets, liabilities, and cash flow to gauge financial health and performance. Accountants prepare financial statements following a very specific accounting rules like generally accepted accounting principles, that is GAAP, for US companies, or International Financial Reporting Standards IFRS for many international companies. These accounting standards will ensure that financial statements are clear, consistent, and comparable. So, financial data presentation is similar as possible. Financial statements may be prepared for a different time frames. Annual financial statements cover the company's latest fiscal years. Company may also prepare interim financial statements on a monthly, quarterly, or at times semi-annual basis. Interim statements sometimes include fewer components than year-end statements. For example, they may lack a cash flow statement and a statement of retained earning. Financial statements generally give information for both the latest period and prior period to make comparisons much more easier. For example, a financial statement covering 1st of January to 31st of December 2021 would include the statements of both the year, that is 2021, and the previous year, that is 1st January to 31st December 2020. Financial statements may be prepared according to different accounting rules depending on the specificity of your business. Now let us understand what are the importance of financial statements. Now these statements are a sound decision making and a long-term business growth. They present a structured view of a firm's financial performance and position. This information will support planning, control, and accountability. The very first importance is for the informed business decision. Financial statements reveal the company's true financial health through incomes, expenses, assets, and liabilities. So they help the management to make informed decisions regarding the pricing, budgeting, hiring, and expansion. Decisions are based on data rather than assumptions. Now the second importance is the investor and the lender's confidence. Investors and lenders rely on financial statements to evaluate a business's creditability and financial stability. The more the transparent and accurate the statement are, they will actually build the trust and demonstrate the good governance. This improves access to funding and strategic partnership. The third importance is regulatory compliance, especially for India. Indian businesses must comply with Indian AS and the Companies Act 2013 and GST regulations. Financial statements ensure the adherence to statutory and tax requirements. Proper reporting reduces the risk of penalties, audits, and legal issues. Now, there are few elements of financial statements. To understand a company's financial position, both on its own and within its industry, you need to review and analyze elements of financial statements. The value of these documents lies in the story they tell when reviewed together. There are four primary types of financial statements that provide valuable insights into a company's financial position and performance: balance sheets, income statements, cash flow statements, and statement of changes in equity. Let us understand each. Balance sheet. Balance sheet is a snapshot of what the business owns and owes. A balance sheet conveys the book value of a company. It allows you to see what resources it has available and how they are financed as of a specific date. It shows its assets, liabilities, and owner's equity, essentially what it owns, and amount invested by the shareholders. Balance sheet also provides information that can be leveraged to compute rates of return and evaluate capital structure using the accounting equation, that is, assets is equal to liabilities plus owner's equity. Now, what are assets? Assets are anything a company owns with quantifiable value. Liabilities basically refers to a money a company owes to a debtor, such as outstanding payroll expenses, debt payments, rents, and utility, bonds payable, and taxes. Owner's equity basically refers to the net worth of a company. It's the amount of the money that would be left if all the assets were sold and all liabilities paid. This money belongs to a shareholders who may be private owners or any public investors. In short, it tells you whether your business is financially stable and how your resources are financed through debt or your own capital. Now the image given will explain you the assets, the liabilities, and what a balance sheet must include. Now second element is income statements. Income statement is measuring the profitability over the time. The income statement, which is also known as the profit and loss or P&L statements, shows how much money your business earned and spent over a specific period, like a month or a quarter or a year. An income statement overviews a company's revenue, expenses, net income, and earnings per share over a specified period, such as a quarter or a year. This income statement will answer the few key questions. Is the business profitable? It shows your revenue from selling products or services. Second, expenses to generate the revenue and manage your business. Third, net income, that is profit, which remains after your expenses. Fourth, profit and loss on non-core activities excluding current operations. Now the key components of statements, that is income statement, includes revenue, cost of goods sold, gross profit, operating expenses, and net income. As you can see in the image given, the income statement includes revenue. Revenue is basically the total income from sales or services rendered. You can see the cost of goods sold, that is COGS, that is the cost of the producing goods. Third is the gross profit, all the revenue which minuses the cost of goods sold. Fourth is operating expenses, where you can see the cost to run the company, such as rent, salary, and utilities. Net income includes the final profit after paying all the expenses and taxes. Now, the third element is cash flow statement, which is tracking real money movement. While the income statement shows profit, the cash flow will shows the actual cash movement. That distinction is critical, especially in markets like UAE, where cash flow gaps can stall growth or trigger penalties. This statement is divided into three categories: operating activities, investing activities, and financing activities. Operating activities includes everyday business transactions like sales, salary, rent, bills. Investing activity will look for the purchases or the sales of assets like properties, machines, equipments. Financing activities includes loans, repayments, issuing or buying back shares. Cash flow help to answer basic questions like, are we generating enough cash to cover your expenses? Can also ask, are we investing in growth? Can we meet our loan obligations or expand safely? For example, a business with growing profit but consistently negative cash flow from operations might over rely on credit. This shows a red flag for investors or a bank. The cash flow statement shows where money went and if is enough left or incoming to sustainable future operations. As you can see in the image, that the company statements of the cash flow includes the cash flow from operating activities, cash flow from investing activities, and the cash flow from finance activities, all been marked with the blue highlighter. Now, the fourth and the last element for financial statements is statement of changes in equity, that is tracking value for owners. Statement of retained earnings shows the cumulative earnings of the business after any dividend or distributions to the shareholders. This statement also shows the change in retained earning between the opening and closing period of each balance sheet. It may also show adjustments from related parties' transactions. This lesser known but very important statement shows how the equity or maybe the ownership value in a company changes over time. It reflects things like retained earning, that is profits reinvested into business, dividends paid to the shareholders, and the new share issued or bought back. After tracking the equity movement, you can better understand how profits are being used. Are they reinvested to grow the company or distributed to owners? Now, these are the few questions who can be answered. In private businesses, this statement often gets less attention than others. That's because it's vital when raising capital or reporting to the shareholders. You can see in the image that the company statement of the retained earnings includes all the retained earnings from beginning till end, the net income, the dividends, and the closing statements of the retained earning. I would like to summarize the session. Financial statements provide an overview of a company's financial health to stakeholders. The four primary types of financial statements are balance sheet, income statement, cash flow statement, and statement of the shareholders' equity. Understanding how to read financial statements will allow you to make informed investment decisions about a company's performance, stability, and future potential. Let us wrap with a quote. Where numbers raise suspicion, forensic accountants turn financial statements into proof. I hope the session was fruitful. Thank you.